I'm Scarlet. This is Bloomberg ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Global headwinds persist, but global opportunities abound. We'll look at where in the world offers the best growth and value for your dollar. Women in ETFs. Jill Del Senor and Sharon French explain how the rise of passive investing paved the way for women to make inroads. Playing defense to win. The search for haven companies draws in big dollars and starts delivering for investors. Love them or hate them, ETFs are here to stay. And clearly on this show, we are believers of ETFs. So much so that this week marks the 100th episode of ETF IQ. So to my partner in crime, Eric Balchunas, congratulations.
Likewise. Time flies when you're having fun.
Absolutely. We celebrated with some cupcakes, but let's celebrate with check on flows, too.
Yes, I got a sugar rush going, which is perfect because I'm about to go over flows. And it's fitting because the 100th episode, the ETFs in the leaderboard are the old, typical ETFs you see when people are very excited. The ones we talk about almost every week. SPY, IWM, the Qs, HYG. The trading crowd is amped. What's gotten them amped? The trade deal, positive trade talks, and also earnings. So you see a lot of money coming in. And what's fascinating about this is it's the exact opposite of what we saw last week. These four were all on the outflow leaderboard. Speaking of which, let's look at what is on the outflow leaderboard. And again, it's products that were on the inflow last week. So we've had a complete reversal. XLP is number one. That's the staples ETF that people go to when they're feeling defensive. That was number two last week on the weekly flows. So if you're starting to sense like, hey, is the trading crowd getting a little schizophrenic here? The answer is yes. And I can prove it with this chart of weekly flow volatility, which we sometimes break out just to show you how investors are a little inconsistent. So you can see here the volatility of weekly flows is at its highest level since gasp Volmageddon, right? So this is probably, Scarlet, one takeaway from the otherwise really bullish sentiment is that this could end in a second. This is not a very committed type of trading crowd right now. Yeah,
pretty fleeting then, in other words. Let's bring in Ben Levine. He is CIO of 3D Asset Management, and also Sarah Ponczek, a cross-asset reporter for Bloomberg News. Eric showed us the flows, and what got my attention, of course, was the last chart, the volatility in flows. There seems to be a lack of conviction right now owing to some pretty big overhangs. What do you think is the main narrative or narratives driving the market right now?
Well, clearly it's the two main narratives right now are China trade and Brexit. And we're actually starting to see, if not some near-term resolution, at least some a pathway forward for both issues, and especially with Brexit. China, I think the bigger issue right now is whether the October tariffs get delayed or not, followed by December. And I think as long as the market senses that enough progress is being made to at least delay those tariffs and prevent them from being imposed, that helps provide, I think, some clearance for the markets to sort of reverse the August Volmageddon and resume their upward course.
Sarah, let's bring you into the conversation because in terms of themes, you've been looking into sector leadership. What does history show us, especially with the S&P 500 kind of approaching its record high again?
So if you look at leadership, recent leadership, and also over the past 12 months, it's really been driven by those defensive areas of the market. So real estate, utilities, staples, we've seen that in the flows as well. If you look at annual flows so far, that is really where we've seen the most demand. But if you look at history, typically if the S&P or stocks are going to really break out to new highs, that's typically not the leadership that you see. It's typically not completely driven by defensive areas of the market, and certainly not when the stock market is going to top out either. So that could actually give some people hope that there's been so much pessimism that maybe you have more room to run. And I just want to point out that if that is the case, you could see this reversion back to cyclical holdings, cyclical outperformance. And if you've seen such a rush into these defensive areas of the market, you have to wonder if you're going to see a really quick reversal of that as well.
I feel like we're constantly waiting for regime change or looking for signs of regime change, Eric. We talked about the U.S.-China trade deal. We also talked about Brexit. These are big international overhangs, but it's not really stopping people from going into international funds.
Yeah, there was a huge trade, probably a model portfolio, I think, this is my theory. $2 billion came out of VU, which is S&P, and about $1 billion went into IXUS and VXUS, which is the international ex-US. You like international. You find it to be a good trade right now, and you have 5 ETFs that you like that we are about to show. And just talk about why you like that and which ETFs you're using.
I think it's more of a convergence trade. Certainly the fundamentals in the U.S. have justified the strong outperformance of the U.S. versus international markets, but at the margin, we're starting to see some good news now being priced into international markets. With Japan, we're starting to see a rally following concerns about the imposition of an increase in their consumption tax. And in Europe, of course, we're seeing some potential resolution over Brexit. And then the macro numbers out of China are starting to turn around with manufacturing sentiment, credit impulse, and so forth. So yeah, these things at the margin, even with manufacturing sentiment, particularly in Germany, still in the doldrums, we're starting to see some marginal good news get priced into the market. And I get the sense that a lot of global asset allocators are sensing that shift in sentiment.
You know, we talk about believing in the U.S. consumer, Sarah. That should argue for small caps doing well, but we know that the trend of the small caps recovering ended before it really got started. What happened there?
Right. So when you think about the outperformance in small caps that we did see back in September, remember that was really part of a larger trade where things that didn't work earlier in the year started to work. That included cyclicals, that included value, that included international countries as well. And we've seen that start to fade again. So if you actually look at the relative performance of the Russell 2000 versus the S&P, it's pretty much taken out all that outperformance we saw during that month. We've also seen inflows to IWM, the Russell 2000 ETF, really peter out because September was the strongest month for inflows since 2016 November during the presidential election. And the problem is you can think of small caps as a macro play, a play on the U.S., but if you actually look at the fundamentals right now, they're just not there. Jeffrey sees a forecast of a decline, a contraction in earnings growth for small caps of 14% in the third quarter compared to a much smaller contraction for the S&P. And if you look at it on a yearly basis, the Russell 2000 is actually expected to see a decline in profits of roughly 4% across the year. So if you don't have the profits, if you don't have the fundamentals, it's hard for people to really get behind this trade.
So Sarah just basically summarized Marianne Bartels, who was on. She did not like small caps, said go to large. But you're with Michael Burry of The Big Short. He likes small caps, thought they were forgotten by this whole beta vortex. You use EES, too, which is an interesting selection. Why small caps and why EES?
Well, Sarah has a good point in terms of pointing about talking about the poor fundamentals that characterize small caps. Several strategists, particularly Mark Holber, have noted that almost 40% of the Russell 2000 is operating at a loss. And so the earnings isn't there like what you saw in large cap. The reason why we think smart beta or alternative indexing approaches to small cap make sense is because much of the small cap universe does trade or currently has negative earnings. And so we like products like EES or dividend weighted strategies that focus on companies that are actually generating earnings, generating dividends, and not operating at losses.
Yeah, putting those small caps through another filter. Ben Levine of 3D Asset Management, thank you so much for your time today. And, of course, our Bloomberg's Sarah Ponczak. Now, coming up, Jill Del Senor and Sharon French, co-presidents of the group Women in ETFs. They'll be discussing paving the way for women in the industry. And one fund that caught our attention this week, IAU. This is BlackRock's iShares Gold Trust. IAU is indicative of holdings in ETFs backed by gold because this group saw 21 straight sessions of inflows. IAU in particular saw its biggest 5-day inflow since 2011. And of course, you can find that chart and all the others we feature on Bloomberg at GTV Go. This is ETF IQ. I'm Scarlet Fu. This is ETF IQ. Let's take you through the ETF life cycle, which has 3 main stages. And we always start with the filing. Cryptoin Investment Advisors is a new issuer, and it wants to try its hand at a Bitcoin fund with the Cryptoin Bitcoin ETF Trust. That's a mouthful. We know the SEC has not been sold on any Bitcoin ETFs so far. It just rejected Bitwise's proposal last week. Step 2 is the launch. Howard Capital Management is another new issuer. Its HCM Defender 100 Index ETF will target the largest 100 non-financial U.S. stocks, while its HCM Defender 500 Index ETF will invest in, guess what, S&P 500 stocks. And for some, the final stage is liquidation. The Wisdom Tree Global ex-Mexico Equity Fund is closing. XMX launched in early 2017 at the start of the Trump administration. The fund invests in the biggest firms globally, excluding any Mexican companies. Assets peaked at $250 million in mid-2018 before falling below $5 million this year. Time to get passive aggressive, where we track the tensions between active and passive investing. Now, the shift to index funds and ETFs, as we know, disrupting the asset management industry, but it's also created an opening for women. Let's talk about why and how with Jill Del Señor and Sharon French. They are co-presidents of Women in ETFs, an industry group for 5,295 members who work in exchange-traded fund products. Great to see you both. Thank you so much.
Of course, thanks, Scarlet.
So this group is now 5 years old, and both of you were there from the start. Talk a little bit about the impetus for creating the Women in ETFs group.
Yeah, sure. So it was really the realization that there was a gap in this very, very fast-growing industry segment as it relates to connectivity. So as you know, there's different parts of the ETF ecosystem, whether you're on the capital market side as an authorized participant or market maker, an exchange, an ETF issuer, an index provider. And in order for the industry to grow and thrive, those pieces have to be connected. And so there was a group of women who really dedicated themselves to putting this group together and taking a leadership position and recognizing excellence and fostering that connectivity and really creating a community which would allow people to, sort of plug into any one of those areas and ascend from there.
And Jill, your reach has grown by leaps and bounds. You're now up to almost 5,300 members, as we mentioned, across different cities. You founded the Chicago chapter and countries as well. There are also plenty of male members, too, I understand.
There are. I mean, I think one of the things that we realized when we kicked this off was that quite immediately we realized there really was a gap. There was a need for what we were providing as this outlet to connect, support, and inspire. And very early on had some very important male sponsors of the organization and realized if we didn't have them involved, we were really only having half the conversation. So we were proud that over 20% of our members globally are men. And we actually, for the first time in 2019, actually it was 2018, had chapter leaders that were men, both in New York and in Chicago.
Got it. Now, I guess the big question here is, why is the ETF world seemingly more inviting to women? Here's one explanation from Marie Chandoha. She's the CEO of Charles Schwab Investment Management, by the way, the firm's second female CEO. She told Bloomberg a couple years ago that back then, the ETF business wasn't considered sexy and people had questions about the viability. This wasn't necessarily the sphere that men flocked into, so women were able to make it on the ground floor and grow in ranks. So, in other words, it was new, it was untested, it didn't have the legacy of the old boys network. Yeah. Do you agree? Is that the way you see it?
That's exactly right. So if you think about financial services more broadly, it's been around for hundreds and hundreds of years, right? So de facto, there's sort of an anchoring in that legacy. So given the fact that the ETF industry is rather new, a couple decades old, it allowed women to get in on kind of on the ground floor with an entrepreneurial or an innovative spirit and to really plug into the different parts that allowed them to learn and grow within that ecosystem.
And as the industry's evolved, you see lots of new issuers coming into market, allows those of us, myself included, that came in on the ground floor to grow within the industry as more and more issuers have come in and leadership opportunities have presented themselves.
Also, in the passive world, it seems like there isn't an emphasis on superstars. So maybe men shied away from the passive world and sought to make themselves superstars in the active world.
And there were definitely opportunities that were presented to women along the way, in all aspects too, from investments to marketing to sales and everything in between.
Yeah, and it's really incumbent upon us within our our organization, which is on, as you said, 5 continents, 12 countries, to do things to continue to promote the equality and inclusivity. Like one of the things we're most proud about is on International Women's Day in March, every year, we partner with UN Global Impact, UN Women, Sustainable Stock Exchange, Federation of Exchanges, and we most recently this year rang the bell at 75 stock exchanges around the globe, either the opening or closing bell, to continue to amplify this message around sort of inclusivity and equality, which is important within the industry and specifically in ETFs because we have such a high concentration of women.
Absolutely. Now, both of you have day jobs that are pretty all-consuming. Sharon, you're the CEO and president of AIG Life and Retirement Funds. Jillian, you're the head of U.S. ETF distribution at JP Morgan Asset Management. How much time do you guys spend on women in ETFs versus your regular job, or do they work together hand in hand?
Precisely, Scarlett. They really do go hand in hand. You know, I think about the opportunities that women in ETFs has provided to 5,200 people around the world to take on leadership roles. We have a lot of people that make up the leadership of women in ETFs around the world, and it provides them the opportunity to lead and potentially provides them with opportunity to lead in their own organizations as a result. So I do believe, while we are all volunteers and have day jobs, I do believe that the opportunities we're given through women in ETFs have helped progress a lot of careers.
And we also are proud of the fact that we've created for the media and for conferences the ability to tap into our network with a speakers bureau. So we've very specifically curated and chosen industry experts who are media trained on specific topics. So then when there's a need for some sort of discussion on an ETF issue, that we can put forth this list of females who have this industry expertise. So the Speakers Bureau has been very, very helpful to the industry in order to promote diverse thought across a particular subject matter.
So a resource for industry events as well. Thank you so much, ladies. Jill Del Senor and Sharon French of Women in ETFs. Now, coming up, we dig into an ETF that is built for the best and the worst of times. This is ETF IQ on Bloomberg. I'm Scarlet. This is ETF IQ. For every ETF offering exposure to a strategy or a factor, others are quick to follow suit. Appetites for low volatility stocks are running high, and funds that feature companies with muted price swings are very much in favor. I counted 43 U.S. listed ETFs with either low or minimum volatility in their description, including one from Franklin Templeton. The firm's head of capital markets and global ETFs, David Mann, is here with us now. But before we get to David, Eric Balchunas is going to give us the drill down into the firm's fund.
Thank you, Scarlet. Yeah, it's a feeding frenzy for low vol this year. I call it a craze. Everybody's piling in. It's probably the trade of the year. And guess what? This is the best performing of the lot, although not the most popular. 56 million, decent. 29 bips is a little high for a low vol, but very low for an actively managed low vol. That's what this is. It's actively managed. They use fundamental stock picking to reduce the volatility. Let's look at this versus the big dogs, SPLV and USMV. It is more like USMV in that it's sector constrained. So that's why you're going to have tech as the highest holding, more like a regular index. SPLV just goes for the lowest vol, then you get utilities and staples. So that's what's more like USMV in a way, but active. Now let's look at the performance of it versus these three, and you can see it's kind of got an edge on all three. And the reason for that is because it does have a little extra tech. And tech, even though it doesn't seem like it, is one of the best performing sectors this year, above and beyond utilities, staples, and other sectors. So that's giving it the edge. The question, Scarlett, is, is it low vol? And the answer is it's going to be a little higher vol than USMV and SPLV, but lower than the S&P.
Yeah, because of that tech exposure. All right, still with us is David Mann of Franklin Templeton. And clearly, as Eric showed us, you've got the performance, but this is a crowded space. Almost 24 low volatility or minimum volatility ETFs in the U.S. How do you distinguish your fund? How do you make it distinct?
Sure. And first, congrats on the 100th episode.
Thank
That's
you.
Very exciting. So Eric said it right. It all starts with leveraging the active expertise at Franklin Templeton, leaning on finding the fundamental, leveraging the fundamentals, using the research of the Franklin Equity Group. And what's interesting is low volatility is sometimes a volatile factor in and of itself. So even though this is a low volatility fund, even though we screen for volatility, it starts with picking the right stocks and then using that to make a more long-term evergreen product, which we think is better as a core holding.
So I'm glad you make that point, because there's a note from David Costin of Goldman Sachs about how investors tend to flock to the wrong low vol stocks. He found there's frequent turnover in the low vol group. So owning shares with the stablest earnings growth is a better way to play it than those with muted price swings. In other words, few companies can be relied upon for sustaining these muted price swings. Do you agree with that?
So I think that's an interesting point. I mean, the investors are going to low vol because they probably want to have some sort of upside downside capture, and they maybe are concerned what's going on with the marketplace. There's some level of I want to stay invested, but I want to take a little bit of risk off the table. And so one of the things that we think is interesting is the volatility factor is very volatile at times, and it can outperform one year, it can underperform other years. And so we think starting with the high quality stocks, leveraging the fundamentals, and then screening for volatility will just lead to that smoother ride over time.
you've got FLLV, and you've also got an outperforming high yield ETF, FLHY, beating HYG. So I have a question. How much of these products are you going to your mutual fund active managers? Because most people know Franklin as an active mutual fund shop. How much is it their brain power in these products versus your sort of own ETF area?
Sure. So, at Franklin Templeton, we have active, we have smart beta, we have passive. We just crossed the 5 billion mark. So for the passives, they're going to track an index. For the other two, we're leveraging the entire breadth of the firm and their active expertise. And to your point, when we have active funds, we are going to the same active managers that run a lot of the mutual funds that are going to date, finding gaps in our lineup that we think would make sense in the ETF form, and then leveraging all of that expertise. And
then real quick, ETF rule is out. You've told me you're a big fan of it. Why?
We think that now that as time goes on and as investors say, okay, what's the difference between an active and a passive fund? The ETF rule actually operationally says there's no difference between the two. And so as we continue having those conversations to say, hey, operationally there's no difference, all the liquidity, all the things that you love about ETFs actually apply whether there's an active or an index label on it, we think that will only open the doors more for ETFs going forward.
All right, David Mann of Franklin Templeton visiting us from San Mateo. Thank you so much.
Thanks for the time.
Now, the rush to low-vol or min-vol stocks is just one way of taking a defensive stance. In this week's There's an ETF for That, we highlight a fund that's all about betting big and playing defense. The Invesco Defensive Equity ETF, also known by its ticker DEF, seeks large-cap companies with superior risk-return profiles. The fund's aim, build a wall during periods of stock market weakness while still offering the potential for gains in times of market strength. DEF consists of 100 names that are equal weighted. Its stocks are selected from the S&P 500 using a rules-based quantitative approach that measures each holding's odds of maintaining revenue growth, beta, and down market volatility. Names include Duke Realty, spice maker McCormick, consumer products maker Church & Dwight, and utilities Next Era Energy and Con Edison. DEF holds some $250 million in assets and costs 59 basis points. Since launching in 2006, its returns have closely tracked the S&P 500. Over the past year, it has outpaced the benchmark index. DEF gets a green light in the Bloomberg Intelligence traffic light system, with one warning due to its alternative weighting system. And since it is our 100th episode, shout out to the graphic animators who put together those animation packages for us every week. Incredible stuff. All right, that does it for this centennial episode of ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time, 6 p.m. in London.